Before we begin, a quick and important disclaimer. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or tax advice. I am not a licensed financial advisor. The world of real estate and mortgages is complex and changes frequently. Please consult with a qualified and licensed professional, like a mortgage loan officer and a real estate attorney, before making any decisions regarding your personal financial situation. You've been scrolling Zillow for 6 months straight. You've seen it all. The fixer-uppers that need a miracle, the McMansions you can only dream of, and the one that was perfect but went under contract in 4 hours. But then it happens. You find it. The one. It has the backyard for the dog, the kitchen with the island, it's in the right school district. Your heart is pounding. This is it. You're ready to make an offer. And then a wave of cold dread washes over you as you realize what comes next. The mortgage. Suddenly you're drowning in a sea of acronyms. FHA, USDA, ARM. You're hearing words like conventional, jumbo, points, and PMI. It feels like a foreign language designed specifically to confuse you, to make you feel small, and to trick you into signing away the next 30 years of your life on a bad deal. Sound familiar? Here's the brutal truth the banks don't want you to know. Choosing the right mortgage is the single most important financial decision you will ever make. Not picking the right stock. Not timing the crypto market. This one decision can be the difference between building massive wealth and struggling to stay afloat. It can be the difference between paying off your home a decade early and paying an extra $100, $200, even $300,000 in pure wasted interest. My promise to you in this presentation is simple. We are going to pull back the curtain on this entire confusing industry. We will demystify every single one of these loan types. I will arm you with the knowledge you need to walk into a lender's office not with fear, but with confidence, ready to ask the right questions and demand the best deal for you and your family. By the end of this, you won't just understand mortgages. You will master them. But before we can compare an FHA loan to a conventional loan, or understand what the heck an adjustable rate mortgage is, we have to build a foundation. You can't build a house on sand, and you can't understand mortgage products without first understanding the 4 fundamental pillars that hold up every single home loan in America. Get these 4 concepts and everything else will click into place. Pillar number 1 is the simplest: principal. Think of the principal as the sticker price of the loan. If you agree to buy a house for $400,000 and you put down $40,000, your principal loan amount is $360,000. It's the big number. It's the actual amount of money you are borrowing from the bank. That's it. Simple enough. Pillar number 2 is where the banks make all their money. Interest. Interest is the fee you pay to the bank for the privilege of borrowing their money. It's expressed as a percentage, your interest rate. This isn't part of the home's price. This is the cost of the loan itself. And make no mistake, this is the number that can make or break your financial future. A small difference in your interest rate, even 0.5%, can translate into tens of thousands of dollars over the life of the loan. The principal is what you borrow, the interest is what it truly costs you. Pillar number 3 is the term. The term is simply the amount of time you agree to take to pay the loan back. In the United States, the 2 most common terms are 30 years and 15 years. This choice is a monumental fork in the road. Let's go back to that $360,000 loan. Let's say you get a 6.5% interest rate. If you choose a 30-year term, your monthly payment for principal and interest will be around $2,275. Feels manageable, it's the standard, it's what most people do. But here's the terrifying part. Over those 30 years, you will pay the bank over $459,000 in interest alone. That's right. You paid more in interest than you borrowed in the first place. You bought a $400,000 house, but it actually cost you over $819,000. Now let's look at the 15-year term with the same loan amount and interest rate. Your monthly payment jumps up to about $3,130. That's about $855 more per month. It's a bigger hit to your monthly budget, no question. It requires more discipline. But look what happens. Over those 15 years, you'll pay only $203,000 in total interest. Let me repeat that. By choosing the 15-year term and finding a way to afford that extra $855 a month, you would save over $256,000. $250,000. You would own your home free and clear 15 years sooner, and you'd have an extra $250,000 in your pocket. This is the raw power of understanding the loan term. It's a choice between a lower monthly payment and an astronomical amount of long-term savings. That brings us to the fourth and final pillar, the one that ties it all together: amortization. This sounds like a complicated word, but the concept is crucial. Amortization is the schedule of your payments, showing how much of each payment goes towards interest and how much goes towards your principal. And here's the secret: it's not an even split. In the early years of your loan, especially a 30-year loan, your payment is overwhelmingly interest. You might be sending the bank that $2,275 check every month, but in the first year, maybe only $300 or $400 of that is actually going to pay down your $360,000 loan. The other $1,900 is pure profit for the bank. It's a gut punch, I know. This is why it feels like your loan balance barely moves for the first 5 to 10 years. You're mostly just paying interest. As you get further into the loan term, the scale begins to tip. In year 15, more of your payment starts to go towards principal. In year 25, almost your entire payment is going towards principal, and very little is going to interest. This process is called an amortization schedule. The bank structures it this way to make sure they get their profit up front. It's also why making extra payments, especially early on, is so incredibly powerful. Every extra dollar you pay in the first few years goes directly toward that principal balance, which then reduces the total amount of interest you'll pay for the rest of the loan's life. It's like a cheat code for saving money. So let's recap our foundation. Principal, the amount you borrow. Interest, the cost of borrowing it. Term, how long you take to pay it back. And amortization, the schedule that determines how much of each payment is profit for the bank versus equity for you. Every single mortgage type we are about to discuss is just a different combination, a different flavor of these four pillars. They might have different rules about the down payment, different types of interest rates, or be designed for different kinds of borrowers, but they all operate on these fundamental principles. Now that you have the foundation, you're ready. You're ready to stop being confused and start being strategic. We're ready to finally tackle that alphabet soup, and we're going to start with the single most popular, most misunderstood mortgage in America: the FHA loan. It doesn't stand for First Home in America, but it might as well. This isn't just a loan program. It's a piece of American history, born from the ashes of the Great Depression. Back in the 1930s, the housing market was a wasteland. People couldn't afford homes, and banks were terrified to lend money. The government needed to do something drastic to jumpstart the economy and the American dream. So, they created the Federal Housing Administration. The FHA's mission was simple but revolutionary: to get regular people back into homes by making it safer for banks to lend them money. And how did they do that? They didn't hand out cash. This is the first and biggest misconception. The FHA does not lend you a single dollar. Instead, it provides insurance. It's like a promise to your lender. The FHA tells the bank, "Hey, go ahead and lend money to this person. We've looked at their situation, and if for some reason they can't pay you back, we've got your back. We will cover your losses." Suddenly, for banks, lending to a regular person with a smaller savings account wasn't a terrifying gamble anymore. It was a calculated, insured risk. This single idea changed the face of homeownership in America forever, and its DNA is still present in every FHA loan issued today. So what does that mean for you sitting here trying to buy a house in the 21st century? It means the FHA loan is designed, from the ground up, to be the most accessible entry point to homeownership. It's the open door when other doors might be closed. And its single biggest feature, the one that gets all the headlines, is the down payment. Or rather, the lack of a big one. With a conventional loan, which we'll get to, the magic number you always hear is 20% down. On a $400,000 house, that's $80,000. For most people, that's a mountain of cash that could take a decade to save. The FHA loan looks at that mountain and turns it into a speed bump. The minimum down payment for an FHA loan is just 3.5%. On that same $400,000 house, that's $14,000. Still a lot of money, absolutely. But it's the difference between maybe someday and maybe this year. This single feature is what makes the dream of owning a home a reality for millions of people who would otherwise be locked out, renting for years while they try to save an impossible amount of money. But a low down payment is only half the story. The other side of the coin is credit. The FHA loan is famously flexible when it comes to your credit score. If your credit history has a few bumps and bruises, maybe a late payment a couple of years ago, or a higher credit card balance than you'd like, the FHA is more forgiving. While conventional loans often want to see FICO scores in the high 600s or 700s to get the best terms, the FHA sets the bar much lower. You can potentially get approved for an FHA loan with a credit score as low as 580 and still get that 3.5% down payment. If your score is even lower, between 500 and 579, approval might still be possible, but you'll likely need to bring a 10% down payment. This flexibility is a lifeline. It acknowledges that people are not their credit scores, that life happens, and that a less-than-perfect financial past shouldn't permanently disqualify you from a stable future. So let's recap. A tiny down payment and forgiving credit requirements. It sounds perfect, right? It sounds like a cheat code for buying a house. And it can be. But there is no such thing as a free lunch, especially in the world of finance. The FHA loan comes with a very specific and very significant catch. It's the price you pay for that accessibility. It's called mortgage insurance premium, or MIP. And it's the FHA loan's greatest strength and its most frustrating weakness. Remember how the FHA insures the loan for the lender? Well, that insurance isn't free. You, the borrower, have to pay for it. And you pay for it in two ways. First, there's an upfront mortgage insurance premium, or UFMIP. This is a one-time charge, currently 1.75% of your total loan amount. So on a $386,000 loan for that $400,000 house, that's an extra $6,755. Now, you don't usually have to bring that to the closing table in cash. Most people roll it into their total mortgage balance, so you pay it off over time with interest. It's a bit of a sting, but it's manageable. The second part, however, is the one you really need to pay attention to. It's the annual mortgage insurance premium. This is an ongoing fee, broken up and added to your monthly mortgage payment. The exact amount depends on your loan term, your down payment, and your loan amount, but it's a noticeable addition to your bill every single month. But here's the critical multi-thousand-dollar detail that so many people miss. If you put down less than 10% on your FHA loan, which, let's be honest, is what most people do, that monthly mortgage insurance payment is there for the entire life of the loan. It never goes away. Not in 5 years, not in 10 years, not when you have 20% equity. It stays with you for all 30 years, unless you do one of two things. Sell the house or refinance into a different type of loan. This is the trade-off. The FHA loan opens the front door for you with a low down payment, but it quietly locks a pair of golden handcuffs on you with lifetime MIP. It's the cost of entry. For many, it's a cost they are more than willing to pay. Getting into a home, starting to build equity, and escaping the cycle of rising rents is worth every penny of that MIP. It's a strategic cost to achieve a much larger goal. But you have to go into it with your eyes wide open, understanding that this monthly fee is part of the deal, and you need a plan for how you'll eventually handle it. So who is the perfect candidate for an FHA loan? It's the first-time homebuyer with a steady job but a modest savings account. It's the person who has worked hard to repair their credit, but it's not quite perfect yet. It's the family that needs to get into a stable home for their kids, but can't afford to sideline $80,000 for a down payment. It is not, as some people mistakenly believe, a bad loan or a loan only for low-income individuals. There are income limits, but they are very generous. The FHA loan is a powerful strategic tool. It's a stepping stone. It's designed to get you in the game. It's often not the loan you keep for 30 years, but it's the one that lets you stop paying your landlord's mortgage and start paying your own. It's the people's mortgage. It's the great enabler. It prioritizes access over perfection. But that focus on access comes at a long-term cost. And this is where the big question comes in. Is there another way? Is there a loan that rewards you for having a higher credit score and a bit more saved up? A loan that lets you escape the trap of lifetime mortgage insurance? There is. It's the FHA's biggest rival, the heavyweight champion of the mortgage world, the one that's often seen as the gold standard, the conventional loan. And understanding the battle between these two giants is the single most important decision you will make on your home buying journey. So let's get right to the main event. In one corner, you have the people's champion, the loan that has opened the door to homeownership for millions who thought it was impossible, the FHA loan. And in the other corner, the seasoned professional, the heavyweight champion of the mortgage world, the one that's often seen as the gold standard, the conventional loan. And understanding the battle between these two giants is the single most important decision you will make on your home buying journey. This isn't just about picking a name out of a hat. This is a strategic choice that will affect your monthly payment, your total interest paid, and your financial freedom for decades. So let's break it down round by round and see which loan comes out on top for you. Round 1, the down payment. This is the first barrier to entry for almost every homebuyer. It's the big number you've been saving for. FHA comes out swinging with its signature move, the 3.5% down payment. That's its knockout punch. On a $300,000 home, that's just $10,500. For many people, that number is the difference between renting for another 5 years and finally getting the keys to their own place. The FHA loan was literally designed by the government during the Great Depression to make homeownership more accessible, and this low down payment is its greatest legacy. Now, conventional loans step into the ring, and for years everyone heard the same thing. You need 20% down for a conventional loan. 20%. On that same $300,000 house, that's $60,000. That's a massive, often insurmountable wall to climb. But here's the plot twist that most people miss. That's not entirely true anymore. The game has changed. Today, you can absolutely get a conventional loan with as little as 3% down, especially if you're a first-time homebuyer. Some programs even offer 5% down, so the gap isn't as wide as it used to be. But the FHA's 3.5% is generally easier to qualify for. So, for round one, on pure accessibility and the lowest barrier to entry, the point goes to the FHA loan. It gets you in the game when you might otherwise be stuck on the sidelines. Round two, the credit score. This is where we separate the contenders. Your credit score is your financial report card, and lenders look at it very, very closely. The FHA loan is incredibly forgiving. It's the comeback kid. It was built to help borrowers who might have a few dings and dents on their credit history. You can often get approved for an FHA loan with a credit score as low as 580. In some cases, if you can put 10% down, lenders will even consider a score as low as 500. This flexibility is a lifeline for so many people who are working to rebuild their credit. The conventional loan, on the other hand, is the disciplined primetime fighter. It wants to see a strong track record. The absolute minimum credit score is typically 620, but let's be real, that's just the ticket to get in the door. To get the best interest rates, the rates you see advertised everywhere, you really need to be in the 700s, ideally 740 or higher. Why? Because a conventional loan is not backed by the government in the same way an FHA loan is. The lender is taking on more risk, so they need to be more confident in your ability to pay it back. So who wins this round? It's a split decision. For sheer accessibility and giving people a second chance, FHA wins. But for rewarding financial discipline with better interest rates and long-term savings, the conventional loan takes the prize. A higher credit score on a conventional loan can save you tens of thousands of dollars in interest over the life of your mortgage. And that brings us to the main event, the round that truly defines this entire fight. Round 3, mortgage insurance. This is, without a doubt, the most important and most misunderstood difference between FHA and conventional loans. Listen closely because this could save you a fortune. First, what is mortgage insurance? It's an insurance policy that protects the lender, not you, in case you stop making your payments. It's the price you pay for bringing a smaller down payment to the table. Both FHA and conventional loans have it, but they handle it in drastically different ways. Let's start with FHA. FHA's version is called MIP, which stands for Mortgage Insurance Premium, and it is a 1-2 punch that can be brutal. First, there's an upfront mortgage insurance premium, or UFMIP. This is a one-time fee, currently 1.75% of your total loan amount. On that $300,000 loan, that's an extra $5,250. Now, you don't usually pay this out of pocket, it gets rolled right into your loan balance, so you're paying interest on it for the next 30 years. That's punch number 1. Punch number 2 is the annual MIP, which is paid in monthly installments. This is an extra amount tacked onto your mortgage payment every single month. And here is the FHA's Achilles heel, the part that you cannot ignore. If you put down less than 10%, you will pay this monthly mortgage insurance premium for the entire life of the loan. Let me say that again. For all 30 years. It never goes away unless you sell the house or refinance into a different type of loan. It is a financial ball and chain. Even if you pay your mortgage down and build up 20, 30, or even 50% equity, you are still paying that FHA mortgage insurance every single month. Now let's look at the conventional loans corner. Its version is called PMI, or private mortgage insurance. If you put down less than 20% on a conventional loan, you will have to pay PMI. But here is the game-changing, championship-winning difference. PMI is temporary. It's not a life sentence. By law, once your loan-to-value ratio reaches 78%, meaning you've paid down your loan to where you have 22% equity in your home, the lender must automatically terminate your PMI. Just disappears. Your monthly payment goes down and that money goes back into your pocket. You can also request to have it removed once you hit 80% equity. which can happen even faster if your home's value appreciates. This is a knockout. The ability to eliminate your mortgage insurance is arguably the single biggest financial advantage. A conventional loan has over an FHA loan. That FHA forever fee can cost you tens of thousands of extra dollars over time for no benefit to you. So in the crucial round of mortgage insurance, the conventional loan wins by a technical knockout. Let's move to a quicker round: loan limits. Both of these loan types have a cap on how much you can borrow. Think of it as a weight class in our boxing match. FHA loans have stricter, lower limits that are set by county. In most parts of the country in 2023, the floor is around $472,000, but it can be higher in more expensive areas. This is because FHA is designed to help people buy modest, everyday homes, not mansions. Conventional loans, or more specifically conforming loans, have higher limits set by the Federal Housing Finance Agency. In 2023, for most of the U.S., that limit is over $726,000, and it's even higher in high-cost areas. So if you're buying a more expensive home, a conventional loan is often your only option between these two. It can simply carry more weight. It's a clear win for conventional in this round. So what's the final verdict in this epic showdown? It's not about which loan is better. It's about which loan is better for you right now. The FHA loan is the ultimate entry-level champion. Gets you into the ring. It's perfect if you have a lower down payment saved up, or if your credit score is still a work in progress. It sacrifices long-term costs for immediate accessibility. The conventional loan is the long-term strategic champion. It's the best choice if you have a strong credit score and can put down at least 3 to 5%, and especially if you can put down 20% to avoid PMI altogether. It rewards your financial discipline with lower long-term costs and more flexibility. But what if I told you there was another contender? A fighter waiting in the wings that combines the best of both worlds. A loan that requires absolutely zero down payment and has no monthly mortgage insurance ever. Sounds too good to be true. But for millions of American heroes, it is a powerful reality. And it's called the VA loan. The VA loan isn't just a mortgage product. It's a certificate of appreciation, a thank you note from the nation written in the language of real estate. It was signed into law in 1944 as part of the original GI Bill, designed to help returning World War II veterans transition back to civilian life. The goal was simple: give those who served a tangible foothold in the American dream they had been fighting for. And for nearly a century, it has been one of the most powerful and beneficial loan programs in history. So what makes it so special? Let's start with the single biggest hurdle for most homebuyers: the down payment. We talked about saving 3.5% for an FHA loan, or 5, 10, even 20% for a conventional loan. On a $300,000 home, that's a mountain to climb. It can take years of scrimping and saving, putting off vacations, driving an older car, delaying other life goals. For a young service member, maybe a 25-year-old sergeant just finishing their enlistment, that kind of savings is often pure fantasy. They've been serving, maybe deployed, not necessarily building a massive nest egg. The VA loan looks at that mountain and simply bulldozes it. It offers 100% financing. That means zero down payment. Not a little down. Not low down. Zero. You can go from renting to owning a $300,000 home with literally $0 put down on the principal. This single feature fundamentally changes the timeline of homeownership for millions. It means buying a home for your family isn't a distant 10-year plan. It's something you can do right now. It's the difference between building equity for yourself today versus paying your landlord's mortgage for another decade. It is, without a doubt, the most powerful wealth-building tool offered to our nation's veterans. But the magic doesn't stop there. Remember that pesky, expensive thing we talked about called private mortgage insurance, or PMI? That extra $100, $200, even $300 a month you pay on a conventional or FHA loan when you put down less than 20%. It's the fee that protects the lender, not you. It's money that just vanishes, never touching your principal, never building your equity. With a VA loan, monthly mortgage insurance does not exist. It's not there. It's not a line item. Ever. Let's put that into real dollars. On that same $300,000 home, let's say PMI would have been $150 a month. That's $1,800 a year. Over 5 years, that's $9,000. $9,000 that, with a VA loan, stays right in your pocket. You can use it for home improvements, for your kids' education, for investments, for anything. The absence of monthly mortgage insurance makes your monthly payment significantly lower and frees up your cash flow for the things that actually matter. Now you might be thinking, okay, zero down, no PMI. This sounds like a trap. What's the catch? And that's a smart question. There is a cost, but it's handled in a very different way. It's called the VA funding fee. This is a one-time fee paid to the Department of Veterans Affairs itself. The purpose of this fee is to keep the entire VA loan program running for future generations of service members without relying on taxpayer money. It's a self-sustaining system. The amount of the fee varies depending on a few factors: your branch of service, whether it's your first time using the benefit, and how much you're putting down. For a first-time user with zero down payment, the fee is typically 2.3% of the loan amount. For that $300,000 loan, that's $6,900. Now that might sound like a lot, but here's the crucial part: you almost never pay this out of pocket. In the vast majority of cases, the VA funding fee is simply rolled into your total loan amount. So your loan becomes $306,900, and you pay it off over the life of the loan. Your monthly payment goes up by a small amount, maybe $30 or $40, which is still a fraction of what you would have paid in monthly PMI. And here's another key detail: not everyone has to pay it. Veterans who receive VA disability compensation, certain surviving spouses, and active duty service members who have been awarded a Purple Heart are exempt from the funding fee entirely, making the loan even more affordable. So, who gets to use this incredible benefit? The eligibility list is broad. It includes active duty service members who have served for at least 90 continuous days. It includes veterans who have met minimum service requirements, which typically means 24 continuous months for those who served in the post-Vietnam era, or 90 days during wartime. It also includes members of the National Guard and Reserves who have served for 6 years. And in a provision that honors the ultimate sacrifice, the benefit is often extended to the unremarried surviving spouses of service members who died in the line of duty or as a result of a service-related disability. If you think you might be eligible, the first step is to get your Certificate of Eligibility, or COE, which a good lender can help you do in minutes. But the headline benefits of zero down and no PMI are just the beginning. The VA loan has hidden superpowers. For instance, as of 2020, the VA no longer sets loan limits for veterans with their full entitlement. Before this change, the VA would only guarantee a loan up to a certain amount, which made it difficult to buy a home in expensive areas like California or New York without a down payment. Now that cap is gone. If a lender determines you can afford a $1 million home, the VA will guarantee their portion of that loan, and you can still theoretically buy it with zero down. This was a game changer. Then there's credit. The VA itself doesn't set a minimum credit score. They leave that up to the individual lenders who are actually funding the loan. But because the lender knows the VA is guaranteeing a portion of that loan, reducing their risk, they are often much more flexible with their credit and debt-to-income requirements. It's not uncommon for a borrower to get approved for a VA loan with a 620 credit score, whereas they might need a 680 or even a 700 for a conventional loan with favorable terms. The government's backing gives lenders the confidence to say yes more often. On top of that, VA loans consistently have the lowest average interest rates on the market. Week after week, month after month, if you look at national mortgage rate surveys, VA loans are typically 1/4 to 0.5% lower than conventional loans. That small difference adds up to tens of thousands of dollars in savings over the life of a 30-year mortgage. The program is also designed to protect the veteran. When you buy a home with a VA loan, the bank requires a VA appraisal. But this isn't just about determining the home's value. The VA appraiser must also ensure the property meets the VA's minimum property requirements, or MPRs. They check to make sure the roof is sound, the electrical is safe, the heating works, and there are no major structural issues. They're looking for anything that could be a safety hazard or a major financial burden. Some buyers see this as a hassle, but it's really a free inspection designed to protect you from buying a problematic house. It's one last layer of security for the veteran and their family. The VA loan is a promise fulfilled. It's a tangible benefit earned through sacrifice. It's the key that has unlocked the door to homeownership for generations of men and women who have worn the uniform. But what if you didn't serve in the military? Is the dream of a zero down payment home completely out of reach? What if I told you there's another government-backed loan, a powerful but often overlooked program, that also offers 100% financing? For millions of Americans living in suburban and rural communities, the answer is a surprising yes. And it's one of the best-kept secrets in the mortgage world. It's called the USDA Rural Development Loan. And before you tune out thinking, I'm not a farmer and I don't want to live in the middle of nowhere, you need to hear this. This is arguably the most misunderstood and powerful mortgage product in America for a huge slice of the population. The name is misleading. While it's administered by the U.S. Department of Agriculture, its real purpose is to promote homeownership and economic development in less populated areas. And what the government defines as less populated will absolutely shock you. We're talking about huge swaths of suburban America. We're talking about charming small towns just a 20-minute drive from major metropolitan centers. 97% of the landmass in the United States is in a USDA-eligible area. Think about that for a second. So what makes it so special? It comes down to two magic words: zero down, 100% financing. You do not need a down payment. Let's let that sink in. With a conventional loan, you're trying to scrape together at least 3 to 5%. On a $300,000 house, that's $9,000 to $15,000. With an FHA loan, it's 3.5%, which is $10,500. For millions of Americans, that down payment is the single biggest mountain standing between them and owning a home. It can take years, even a decade, to save that much money, especially while paying rent. The USDA loan bulldozes that mountain. It allows you to finance the entire purchase price of the home. How is this even possible? It works very similarly to the FHA loan we talked about earlier. The USDA doesn't actually lend you the money. Instead, they provide a guarantee to a private lender, a bank or a mortgage company. They essentially tell the lender, hey, if you approve this loan for this qualified buyer in this eligible area, and they default, we've got your back. We'll cover your losses. This government insurance removes a massive amount of risk for the lender. And with that risk gone, the lender is willing to do things they would never normally do, like lend you 100% of the home's value, and often at a very competitive interest rate, sometimes even lower than a conventional loan. Now, this sounds like a dream, and for many people it is. But it's not a free-for-all. There are two major, non-negotiable gates you have to pass through to get this loan. The first gate is geography. The property itself must be located in a USDA-eligible area. Not you, the property. You could work in downtown Manhattan, but if you want to buy a home in a qualifying town in upstate New York or New Jersey, you can use a USDA loan. The USDA has an official eligibility map on their website. You can type in any address in the country, and it will tell you instantly if it's in an eligible zone. And I encourage you to play with it. You will be stunned to see that towns you always consider just normal suburbs are often eligible. The line between an ineligible and an eligible area can literally be one side of a street versus the other. This geographic requirement is the heart and soul of the program. It's designed to incentivize people to build lives and communities outside of the most densely packed urban centers. The second gate is income. This program is specifically designed for low to moderate income households. It's not for the wealthy. Each county in the country has its own specific income limit, which is based on the median income for that area and your household size. A family of 5 will have a higher income limit than a single individual. For example, in one county, the limit for a 1 to 4 person household might be $103,000 a year, while in a more expensive county nearby, it might be $150,000. The key is that it's based on your total household income. That's everyone who will be living in the home, even if they aren't on the loan. Again, the USDA website has a simple tool where you can select your state, your county, and your household size, and it will tell you the exact income limit for your area. This isn't meant to be a punishment. It's a feature. It ensures that this incredible benefit of zero-down financing is reserved for the working-class families and individuals that it was designed to help the most. So, if you pass through the geography gate and the income gate, what's the catch? Well, just like with FHA, there's a form of mortgage insurance. The USDA calls it a guarantee fee. It's how they pay for the program and cover the costs when a loan does go into default. This fee is broken into two parts. First, there's an upfront fee. As of right now, it's 1% of the loan amount. So on that $300,000 loan, that's a $3,000 fee. Now, here's the beautiful part. You don't have to pay this out of pocket. In almost every case, this fee can be rolled right into your total loan amount. So instead of borrowing $300,000, you'd be borrowing $303,000. You finance it over the life of the loan. The second part is an annual fee, which is paid monthly in your mortgage payment, just like PMI or FHA's MIP. Currently, this fee is 0.35% of the outstanding loan balance per year. Let's run the numbers and compare it to FHA because this is critical. On that same $300,000 loan, the USDA's annual fee would be $1,050, which breaks down to an extra $87.50 per month. Now remember FHA? Their annual MIP is typically 0.55%. That would be $1,650 a year, or $137.50 per month. That's a $50 a month difference. Over a year, that's $600 in savings. Over 5 years, that's $3,000. So not only does the USDA loan allow you to get in with zero down, but your monthly payment can also be significantly lower than an FHA loan because their version of mortgage insurance is cheaper. What about credit scores? The USDA itself doesn't set a minimum credit score, but the lenders who actually issue the loans do. Generally, you're going to need a credit score of at least 640 to get an automated approval through the USDA's underwriting system. If your score is a little lower, a manual underwrite might be possible, but it will be tougher. They'll want to see a very clean payment history for the last 12 months and potentially some compensating factors, like a very low debt-to-income ratio or significant savings, even though you don't need it for a down payment. Finally, the property has to meet certain standards. It must be your primary residence. You can't use this to buy a vacation home or a rental property. And it has to be in decent shape, meeting basic health and safety standards. Think safe, sound, and sanitary. A functioning roof, a modern electrical system, a reliable heat source. A home with a swimming pool is usually fine, but a home with a collapsed foundation is not. So let's put it all together. Imagine a young couple. They're both teachers with steady jobs, but with student loans and the high cost of living, they've only managed to save a few $1,000s. They think they're 5 years away from buying a home. They feel stuck. Then they hear about the USDA loan. On a whim, they check the eligibility map and discover that the beautiful, quiet town just one exit further down the highway from the expensive suburb they were renting in is fully eligible. They check the income limits for that county, and their combined salaries fit comfortably underneath the cap. Suddenly, everything changes. The biggest barrier to their dream, that $20,000 down payment, is gone. They can get a loan for 100% of the purchase price. Their monthly payment will be affordable, maybe even less than their rent, because of the low interest rate and the lower cost guarantee fee. For them, this program isn't just a loan. It's a key that unlocks a future they thought was locked shut. This is the power of the USDA loan. It's a specialized tool, a targeted program designed to lift up specific communities and specific people. It's not for everyone or for every house, but for the millions of Americans who qualify, it can be the single most effective and affordable path to homeownership that exists. It's a true game changer. But what if there was a loan program even more powerful than the USDA loan? A program earned through service that offers zero down payment, no monthly mortgage insurance, and some of the most competitive interest rates on the planet? For millions of veterans and active duty service members, this isn't a dream. It's a reality. It's called the VA loan. And it is, without a doubt, the most powerful mortgage product on the market for those who qualify. It's not just a loan. It's a thank you. It's a tangible benefit, a key to a front door, earned through sacrifice and commitment to the country. So let's break down this absolute powerhouse. The headline feature, the one that makes everyone's jaw drop, is the 0% down payment requirement. Let me say that again. 0 down. While your friends are pinching pennies for years to save up the 3.5% for an FHA loan, or the 5, 10, even 20% for a conventional loan, a qualified veteran can walk into a lender's office and finance 100% of the home's purchase price. This single benefit catapults veterans into homeownership years, sometimes even a decade, before they might have otherwise been able to. It completely removes the single biggest hurdle that keeps most people renting. But the magic doesn't stop there. Remember that pesky private mortgage insurance or PMI we talked about with conventional loans? That extra $100, $200, even $300 a month you have to pay if you put down less than 20%? With a VA loan, it doesn't exist. There is no monthly mortgage insurance ever. It's not there. Gone. It doesn't matter if you put $0 down or 10% down. The reason is simple. The loan is partially guaranteed by the U.S. Department of Veterans Affairs. This guarantee gives the lender a safety net, a layer of protection that makes them feel secure. Because the lender's risk is lower, they don't need to charge you that extra insurance premium. Think about what that means. A saving of, let's say, $200 a month is $2,400 a year. Over the first 10 years of your loan, that's $24,000 that stays in your pocket, not the insurance company's. That's a new car. That's a college fund. That's a life-changing amount of money. On top of all that, because of that government guarantee, Lenders often offer incredibly competitive interest rates on VA loans, frequently lower than what you'd find for conventional or even FHA mortgages. And the VA limits the closing costs that lenders can charge the veteran borrower, protecting them from junk fees. So you have zero down, no monthly mortgage insurance, and lower interest rates. Sounds like a fantasy. So who gets to wield this incredible financial tool? Eligibility is, of course, tied to military service. This includes veterans who have met minimum service requirements, active duty service members, and in many cases, members of the National Guard and Reserves. The specific length of service required depends on when you served, whether it was wartime or peacetime. For many, it's as little as 90 consecutive days of active service. The definitive proof you need is a document called the Certificate of Eligibility, or COE. This is the golden ticket. It's a formal document from the VA that proves to the lender that you have the required service to qualify for the loan. Getting one is a straightforward process you can do online, through your lender, or by mail. And crucially, this benefit also extends to certain surviving spouses of service members who died in the line of duty or from a service-related disability, ensuring their families are also cared for. Now you're probably thinking, okay, this sounds too good to be true. What's the catch? And you're right to be skeptical. There isn't a catch in the traditional sense, but there are unique features you absolutely must understand. The most significant one is the VA funding fee. This is a one-time fee paid to the Department of Veterans Affairs to help keep the program running for future generations without any burden on U.S. taxpayers. The fee is a percentage of the loan amount and it varies. For a first-time user of the VA loan putting zero down, it's typically 2.3%. If you use the benefit again for a subsequent home, the fee is a bit higher, usually 3.6%. Now that can sound like a lot of money. On a $300,000 loan, 2.3% is $6,900. But here is the critical part. You do not have to pay this out of pocket. In nearly all cases, the VA funding fee can be rolled right into the total loan amount and paid off over the life of the mortgage. So while it does increase your total loan balance slightly, it doesn't prevent you from getting into the home with no cash out of pocket. Even better, some veterans are completely exempt from paying the funding fee. This includes veterans receiving VA compensation for a service-connected disability and surviving spouses of veterans who died in service or from a service-connected disability. For these heroes, the program becomes even more beneficial. The second unique feature is the VA appraisal and property requirements. The VA isn't just guaranteeing the loan, they're looking out for the veteran. They have what are called minimum property requirements, or MPRs. The appraiser, who is trained and approved by the VA, isn't just determining the home's value. They're also making sure the house is safe, sound, and sanitary. They're checking for a solid roof, a working electrical system, a modern heating system, and no chipping or peeling lead-based paint. They're ensuring the property is free from termites and has adequate living space. Some people see this as a hurdle, thinking the VA is being too picky. But you have to change your perspective. The VA is protecting you, the veteran, from buying a money pit. They are using their leverage to ensure you're moving into a home that is fundamentally safe for you and your family, not one that will drain your finances with immediate, major repairs. Finally, a VA loan is intended for your primary residence. You must intend to occupy the home you're buying. This isn't a program designed for buying vacation homes or purely investment properties right off the bat. It's about putting our nation's service members and veterans into stable homes of their own. So let's put it all together. A young Marine just finishing her first enlistment wants to provide a stable home for her family. She has great credit and a steady job lined up, but she hasn't had the time or income to save a $20,000 down payment. With a conventional loan, she's out of luck. With an FHA loan, she still needs to scrape together thousands. But with her VA loan benefit, she gets her certificate of eligibility, finds a lender who specializes in VA loans, and starts house hunting. She finds the perfect 3-bedroom home for her family. It passes the VA appraisal with flying colors. She moves to the closing table with $0 down. She rolls the funding fee into her loan. Her monthly payment is affordable because her interest rate is low, and more importantly, she has no monthly mortgage insurance payment. She is a homeowner. Her kids have a backyard. She has built a foundation for her family's future, all made possible by a benefit she earned through her service. That is the profound power of the VA loan. It's a specialized tool for a specialized group, and for those who can use it, it is life-altering. Now we've covered a loan for the average buyer who needs a little help, the FHA loan. We've covered the gold standard for financially strong buyers, the conventional loan, and we've just honored our veterans with the incredible VA loan. But our journey across the American landscape of homeownership isn't over. What about the parts of America that are often forgotten? The small towns, the rural communities, the wide open spaces? What if your dream isn't a condo downtown or a house in the suburbs, but a home with a little bit of land, far from the city lights? You might think financing a dream like that would be difficult, if not impossible. But there's another government-backed loan, a hidden gem that offers benefits that rival even the mighty VA loan. It's designed specifically for America's heartland, and it might just be the most overlooked mortgage program in the entire country. It's called the USDA loan, and its core promise is so staggering, so counterintuitive to everything we're taught about buying a house, that most people dismiss it as a typo. What if I told you there's a mortgage that requires absolutely zero down payment, and it's not just for veterans? A loan where you could, in theory, walk into a house with nothing more than the cash for closing costs, and sometimes you can even get the seller to pay for those. This isn't a fantasy. This is the USDA Rural Development Guaranteed Housing Loan. And before you tune out thinking, I don't want to live on a farm, let me stop you right there. That is the single biggest misconception about this program, and it's a misconception that costs thousands of American families their dream home every single year. The USDA loan is not for buying farms. It's for buying regular, single-family homes in areas the U.S. Department of Agriculture has designated as rural. And here's the secret that will blow your mind. The USDA's definition of rural is incredibly broad. We're not talking about a log cabin in the middle of a cornfield, miles from civilization. We are talking about 97% of the geographical United States. 97%. This includes suburbs, small towns, and communities on the outskirts of major metropolitan areas. There are eligible properties within a 1-hour drive of almost every major city in America, from Dallas to Chicago, from Atlanta to Denver. It's a program designed to encourage growth in homeownership outside of the most densely packed urban centers. And the map of eligible areas looks less like a few dots in the countryside and more like a giant blanket covering almost the entire nation, with just a few holes cut out for the big cities. So, how does this miracle loan actually work? Like FHA and VA loans, it's a government-backed program. The USDA isn't lending you the money directly. Instead, they provide a guarantee to a private lender like a bank or credit union. This guarantee is like a cosigner from Uncle Sam, telling the lender, hey, if this borrower defaults, we'll cover the loss. This drastically reduces the lender's risk, and when risk goes down, two magical things happen for you, the borrower. First, the down payment requirement vanishes. Poof, gone. 100% financing. For millions of people, the single greatest barrier to owning a home isn't the monthly payment. It's saving up that massive lump sum for a down payment. Think about it. Saving 3.5% for an FHA loan on a $300,000 house is over $10,000. Saving 5% for a conventional loan is $15,000. For many working families, trying to save that kind of cash while paying rent and dealing with inflation feels like trying to fill a bucket with a hole in it. The USDA loan solves this problem completely. Second, you get access to very competitive interest rates, often on par with or even better than conventional loans, because again, the lender's risk is so low. But the financial benefits don't stop there. Let's talk about mortgage insurance. We know that with a conventional loan, if you put down less than 20%, you have to pay PMI. With an FHA loan, you pay an upfront mortgage insurance premium and an annual premium for the life of the loan. The USDA loan has its own version called a guarantee fee, but it is almost always significantly cheaper than FHA's mortgage insurance. Let's put some real numbers on this. The USDA has an upfront guarantee fee, which is typically rolled into the loan amount so you don't pay it out of pocket. Then there's a small annual fee, paid monthly as part of your mortgage payment. But that annual fee is substantially lower than the FHA's. Over the life of the loan, this difference can save you tens of thousands of dollars. We're talking about a lower monthly payment month after month, year after year, compared to an FHA loan for the exact same house price. It's a double win. No down payment upfront and a lower payment over time. So at this point, you're probably thinking, this sounds too good to be true. There has to be a catch. And there are. But they aren't catches, so much as they are specific eligibility requirements designed to ensure the program helps the people it's intended for. There are two major hurdles you have to clear. The first, as we've discussed, is geography. The property itself must be located in an eligible rural area. This is non-negotiable. But finding out is incredibly easy. The USDA has an eligibility map on their website. You can literally type in the address of a house you're interested in, and it will tell you instantly if it qualifies. I urge you, even if you think you live in a suburban area, to go check that map. You will be shocked. You'll find entire towns, beautiful neighborhoods with great schools, just a few miles outside a major city's limits, are fully eligible. It's like a hidden treasure map for affordable homes. The second major hurdle is income. This loan is specifically designed for low to moderate income households. This means you can't make too much money. The income limits vary wildly depending on where you live and how many people are in your household, because the cost of living is different in rural California than it is in rural Alabama. The USDA sets these limits by county. For example, in one county, the limit for a 4-person household might be $90,000, while in a more expensive county, it could be over $120,000. The key takeaway is this: the program is aimed squarely at working-class and middle-class families. It's for the teachers, the firefighters, the nurses, the skilled trade workers, the people who are the backbone of our communities but are getting priced out of the housing market. Let's imagine a young couple, Sarah and Alex. Sarah is a dental hygienist and Alex works in IT. They have good, stable jobs and a decent credit score, around a 680. They've been saving for years, but every time they get close to a down payment, life happens. A car breaks down, a medical bill pops up. They feel stuck, renting an apartment while their friends who had family help are buying homes. They assume their only option is an FHA loan, and they're still $5,000 short of the down payment they need for even a small starter home in the city. Then a loan officer mentions the USDA loan. They laugh at first. "We're not farmers," they say. But the loan officer pulls up the eligibility map. They see a town 25 minutes from their jobs, a place they'd only ever driven through, is completely eligible. It has a charming main street, a great park, and the schools are highly rated. They go to the USDA income eligibility site, type in their county and their combined salaries. A green check mark appears. They qualify. Suddenly the entire game changes. They aren't just looking at cramped condos anymore. They start looking at 3-bedroom houses with backyards for a future dog. They find a home they love listed for $325,000. With an FHA loan, they would have needed over $11,000 for the down payment alone. With the USDA loan, they need zero. Their loan officer even helps them negotiate to have the seller cover most of their closing costs. They end up going to the closing table and paying less than they would have for a security deposit on a new apartment. Their monthly payment, thanks to the lower guarantee fee, is nearly $100 less than it would have been with an FHA loan. For Sarah and Alex, the USDA loan wasn't just a mortgage. It was a key that unlocked a future they thought was completely out of reach. This story plays out in real life every single day. The USDA loan is, without a doubt, one of the most powerful homeownership tools in the United States, yet so many people have never even heard of it, or they dismiss it based on the name alone. It's 100% financing. It has lower monthly costs than its main government-backed competitor, and it's available in the vast majority of the country. If you think homeownership is impossible because of the down payment, you owe it to yourself to check that map. Now, all the loans we've talked about so far, conventional, FHA, VA, and USDA, have one major thing in common. They are almost always fixed-rate mortgages. Your interest rate is locked in for 30 years, giving you stability and predictability. But there's another, more volatile type of mortgage. A financial instrument that can either save you a fortune or cost you your home. It's a high-risk, high-reward gamble that Wall Street loves and that many homebuyers fear. It's time we talk about the wild card of the mortgage world, the adjustable rate mortgage, or ARM. It's a chameleon, a shapeshifter in a world of financial certainty. While a fixed-rate mortgage is like a rock, solid, predictable, unchanging for 30 years, an ARM is like the ocean. It can be calm and inviting for years, but its nature is to move, and you have to be prepared for when the tide changes. Now, I know what some of you are thinking. ARMs. Weren't those the villains of the 2008 financial crisis? The ticking time bombs that blew up the housing market and wrecked the global economy? Yes and no. The ARMs of that era were a different, more predatory breed. Today's versions have more safety features built in, but the fundamental principle and the risk remains the same. So why on earth would anyone sign up for this uncertainty? That's the multi-trillion-dollar question, and the answer is surprisingly logical if you know what you're doing. Let's first break down how this thing actually works, because the name adjustable rate mortgage is both perfectly descriptive and horribly vague. An ARM is split into two distinct phases. First, there's the introductory period. This is the honeymoon phase. For a set number of years, your interest rate is fixed, and it's almost always lower than the rate you could get on a standard 30-year fixed loan. This is the bait. It's the reason anyone even considers an ARM in the first place. You'll see them advertised as a 5-1 ARM, a 7-1 ARM, or a 10-to-1 ARM. That first number is the length of your honeymoon. A 5-to-1 ARM means your rate is fixed for the first 5 years. A July 1st means it's fixed for 7. Simple enough. But honeymoons end. And that's where the second number, the 1, comes into play. This tells you how often your interest rate will adjust after the initial fixed period is over. In a 5-to-1 or 7-to-1 ARM, the 1 means the rate will adjust once every year for the rest of the loan's term. So after year 5, your rate will change. Then it will change again in year 6, again in year 7, and so on. But change to what? This isn't just the bank manager waking up one morning and deciding to double your rate. The adjustment is tied to a specific financial benchmark, an index. Think of the index as the wholesale cost of money in the economy. A common one used today is called the SOFR, or the Secured Overnight Financing Rate. When you hear on the news that the Fed is raising or lowering interest rates, that market movement is reflected in indexes like SOFR. Your bank doesn't control the index, the market does. So your new rate is calculated with a simple formula: index plus margin. The margin is the bank's profit. It's a fixed percentage that gets added to the index, and it never changes for the life of your loan. If the index is at 4% and your margin is 2.5%, your new interest rate is 6.5%. If the index skyrockets to 7% next year, your new rate becomes 9.5%. You can see how this gets dangerous fast. This is where the most critical feature of a modern ARM comes in, the caps. These are the safety rails that are supposed to keep your mortgage from flying off a cliff. There are 3 of them. First is the initial adjustment cap. This limits how much your rate can jump the very first time it adjusts. So if your initial rate was 4% and you have a 2% initial cap, the highest your rate can go in year 6 is 6%, even if the market index suggests it should be higher. Second is the periodic cap, or subsequent cap. This limits how much the rate can change in all the following years. A 2% periodic cap means your rate can't go up or down by more than 2 percentage points from one year to the next. Finally, and most importantly, is the lifetime cap. This is the absolute ceiling. It's the highest your interest rate can ever go, no matter what happens in the economy. Typically, this is set at 5% or 6% above your initial starting rate. So if you started at 4%, your rate will never, ever exceed 9% or 10%. These caps are your worst-case scenario. You need to know them, understand them, and be able to afford your payment at that lifetime cap before you ever sign the papers. So, after hearing all that, the question remains, why? Why take this risk? The answer lies in your life plan. An ARM isn't a 30-year commitment. It's a strategic tool for a specific window of time. Let's say you're a surgical resident. You know you'll be in a city for your 5-year residency program, and then you're moving. Or maybe you're in the military and have orders for a 4-year posting. Why would you pay the higher interest rate on a 30-year fixed loan when you know with near certainty that you will sell the house in 4 or 5 years? You could take a 5-to-1 or 7-to-1 ARM, get a significantly lower interest rate and a lower monthly payment for the entire time you own the home, and then sell it long before the first rate adjustment ever happens. You get all the benefits of the low introductory rate with none of the long-term risk. It's also a tool for people who expect a major jump in income. Maybe you're starting a business or finishing a graduate degree. You can afford the house now, but just barely. An ARM can give you the breathing room of a lower payment for the first few years, with the expectation that by the time the rate adjusts, your higher income will easily absorb any potential increase. It's also a bet on the future. If you're buying a home when interest rates are at a historic high, you might take an ARM thinking that in 5 or 7 years, rates are likely to have come down. If they do, your rate will adjust downward, and you'll save money without even having to refinance. But for every one of these strategic uses, there's a horror story. The dark side of the ARM is something called payment shock. It's a sanitized, clinical term for a brutal reality. It's the feeling of opening your mortgage statement and seeing that your payment has jumped by $500, $700, or even $1,000 a month. That comfortable $2,800 payment you had for 5 years could suddenly become $3,500. And the next year, maybe $4,200. This is the trap that millions of Americans fell into leading up to 2008. They were sold on the dream of a low teaser rate, often without fully understanding that the rate would reset, and reset dramatically. They could afford the house on day one, but they were never meant to afford it in year 6. When the adjustments came, they were washed away in a tsunami of foreclosures. Today's rules are stricter. Lenders are now required to qualify you not just on the low starting rate, but on your ability to handle a higher, fully indexed rate. This weeds out many people who would have been put in a dangerous position a decade ago, but it doesn't eliminate the risk. Life happens. You might plan to move in 5 years, but then you have a child, you love the school district, and your plans change. You might expect a big promotion, but then your company has layoffs. The future you were banking on might not arrive on schedule, but that rate adjustment will. It's a ticking clock. An adjustable rate mortgage is financial dynamite. In the hands of a skilled demolition expert, someone with a clear plan, a defined timeline, and a solid exit strategy, it can be an incredibly effective tool. But in the hands of an amateur or someone who is just hoping for the best, it can blow up in your face. It demands a level of foresight and risk tolerance that is fundamentally different from the set it and forget it nature of a fixed-rate loan. So we've covered the big three: the gold standard conventional loan, the accessible FHA loan, and now the high-stakes arm. These are the workhorses of the mortgage industry. But what if you don't fit neatly into one of these boxes? What if your story is different? What if you're a veteran who has served this country, or someone who dreams of owning a home in a small rural town, far from the city lights? For you, the government has created special pathways to homeownership, with benefits so incredible, they can seem almost too good to be true. And that's where we're going next. Let's talk about two of the most powerful mortgage programs in existence, designed for two very different American dreams. First, the USDA loan. When you hear USDA, you probably think of the stamp on a steak. But the U.S. Department of Agriculture also has a mission to help develop rural and suburban communities. And to do that, they created a home loan program that is, for many, the single best path to homeownership. Why? The headline feature is almost unbelievable. 0 down payment. Not 3%, not 5%. 0. You can buy a home with literally no money down. This isn't some late-night infomercial promise. It's a legitimate, government-backed program. The goal is to encourage people to buy and build in less populated areas, strengthening those communities. Now, your first thought is probably, okay, but rural means I have to live on a farm in the middle of nowhere, right? And this is the biggest misconception about the USDA loan. The USDA's definition of rural is incredibly broad. It includes huge swaths of suburban America. You would be absolutely shocked to see the maps. We're talking about charming small towns, quiet suburban neighborhoods just outside major city centers, and beautiful communities that are far from what you'd consider the sticks. There are two main requirements. First, the property itself must be in an eligible area. The USDA has an easy-to-use eligibility map on their website. You just type in an address and it tells you instantly if it qualifies. I encourage you, even if you think there's no way your area is eligible, go check. You might be sitting on a gold mine of opportunity without even knowing it. The second requirement is based on your income. These loans are designed for low to moderate income households. But again, low to moderate is relative. The income limits vary by county and household size, and they are often much higher than people assume. In many counties, a family of 4 can make well over $100,000 a year and still qualify. So it's not just for very low-income families. It's for the working class and middle class families that form the backbone of these communities. So what's the catch? There are two things to know. First, similar to an FHA loan, there is a form of mortgage insurance. It's called a guarantee fee. There's an upfront fee, which is usually just rolled into your total loan amount so you don't pay it out of pocket, and a small annual fee that's paid monthly as part of your mortgage payment. It's typically lower than FHA's mortgage insurance, but it's there. Second, the loan is only for your primary residence. You can't use it to buy a vacation home or an investment property. But think about the power of this. Imagine being a young couple, maybe a teacher and a firefighter, who have been saving for years but keep seeing home prices outpace their savings. They feel hopeless. Then they discover a beautiful town 25 minutes outside the city where they work. The schools are great, the community is tight-knit, and because it's in a USDA-eligible zone, they can buy a home with no down payment, finally giving their family a place to put down roots. That is the power of the USDA loan. It's a key that unlocks a different kind of American dream. But what if your dream wasn't defined by where you want to live, but by a commitment you already made? A commitment to serve this country. For those who have worn the uniform, there is another, even more powerful program. A benefit earned through sacrifice, courage, and dedication. This is the VA loan. Guaranteed by the U.S. Department of Veterans Affairs, the VA loan is, without a doubt, the single best mortgage product on the market, and it's exclusively for those who have served. We're talking about active duty service members, veterans, and in some cases surviving spouses. This isn't just a loan program. It's a thank you. It's a promise from the nation that when you come home, the door to homeownership will be wide open. Like the USDA loan, the VA loan also offers a true zero down payment option. For many veterans, this is life-changing. It means you don't have to spend years saving up a huge chunk of cash after transitioning back to civilian life. You can provide stability for your family right away. But here is where the VA loan pulls away from every other loan on the planet. Are you ready for this? With the VA loan, there is no monthly mortgage insurance. Period. Let me repeat that because it's that important. No, monthly mortgage insurance. Let's put that into perspective. On a $400,000 FHA loan, you might pay over $300 a month in mortgage insurance. On a conventional loan with low money down, it could be $150 or $200 a month. With a VA loan, that number is zero. That is hundreds of dollars back in your pocket every single month. Thousands of dollars every year. Over the life of the loan, we're talking about tens of thousands of dollars in savings. This isn't just a small perk. It's a massive financial advantage that gives veterans significantly more buying power and a lower monthly payment. On top of that, VA loans generally have some of the most competitive interest rates available, and the VA limits the closing costs that lenders are allowed to charge the veteran. The system is designed from top to bottom to protect and benefit the service member. So what's the catch here? It's not really a catch, but a cost called the VA funding fee. This is a one-time fee that helps keep the program running for future generations of veterans, and the cost varies. It depends on your branch of service, how much you're putting down, if anything, and whether it's your first time using your VA loan benefit. The great part is that, just like the USDA's fee, it can be rolled right into the loan amount. You don't have to pay it out of pocket. And here's another incredible benefit. Veterans who receive VA disability compensation are typically exempt from paying the funding fee entirely. That's a savings of thousands of dollars right at the closing table. Unlike the USDA loan, there are no income limits to qualify, and no geographic restrictions. You can use your VA loan to buy a condo in downtown Miami, a ranch in Texas, or a townhome in Seattle. The benefit follows you wherever you want to plant your flag. This is more than just a financial transaction. Imagine a young Marine finishing her first enlistment. She's seen the world, she's served her country, and now she's ready to come home. She thinks buying a home is a decade away, but her lender tells her about the VA loan. She finds out she can buy a home right now with zero down, and with a monthly payment that's actually less than what she'd pay in rent because she doesn't have PMI. That's not just a loan. That's a life-altering opportunity she earned. So you have these two incredible government-backed options. The USDA loan, opening up the dream of homeownership in America's heartland, and the VA loan, a powerhouse benefit for our nation's heroes. They shatter the myth that you need a 20% down payment to buy a home. So now you know the players. The steady conventional, the accessible FHA, the flexible ARM, the rural-focused USDA, and the unbeatable VA. You have the full arsenal of options. You've identified the one that seems perfect for you. You're ready to take the leap. But knowing what you want is only half the battle. The other, more critical half is the how. How do you actually get from here to holding the keys in your hand? How do you navigate the maze of paperwork, the lender negotiations, and the underwriting process that can make or break your dream? Because having the perfect loan in mind means nothing if you can't get approved. And that final crucial step from application to approval is exactly where we're going next. So you've submitted your application. You've handed over a mountain of paperwork, pay stubs, tax returns, bank statements, enough to document your entire financial life. Now what? Now your file enters the mysterious, often misunderstood world of underwriting. This is the final gatekeeper. The person you'll never meet, whose name you might never know, but who holds the power to say yes or no to your dream of homeownership. Think of it this way, everything we've talked about so far, choosing between FHA and conventional, understanding ARMs, exploring VA and USDA loans, that was you choosing your weapon for battle. The application process is you stepping onto the battlefield. But underwriting is the final boss fight. And the underwriter's job is simple, but ruthless: to assess risk. They are the bank's protector. and their mission is to ensure that you are not just a good person, but a good bet. To do this, they look at your entire financial picture through a very specific lens, a framework often called the 4 C's of credit: capacity, capital, collateral, and credit. Get these 4 things right and you're virtually unstoppable. Let's start with the first C, capacity. This isn't about how much you feel you can afford. It's a cold, hard calculation. The underwriter is asking one question: does this person have the capacity to repay this massive loan every single month for the next 30 years without fail? Their primary tool for this is your debt-to-income ratio, or DTI. We've mentioned it before, but now it's under the microscope. They take all your monthly debt payments, car loans, student loans, credit card minimums, and the proposed new mortgage payment, and they divide it by your gross monthly income. If you make $6,000 a month and your total debts, including the new house payment, are $2,700, your DTI is 45%. For a conventional loan, that's right on the edge of the typical limit. For an FHA loan, you might be able to go a little higher. The underwriter isn't just looking at the number. They're stress testing your life. What if your car breaks down? What if you have a medical emergency? A high DTI leaves no room for error, and that makes them nervous. They will verify every single dollar of your income, scrutinizing your W-2s, tax returns, and even calling your employer to confirm you're still employed right before closing. Your capacity must be undeniable. Next up is the second C, capital. This is the money you have saved up. It's your skin in the game. The underwriter wants to see that you have enough cash for 2 things: the down payment and closing costs, and reserves. Reserves are the secret ingredient most first-time buyers don't know about. This is the money you'll have left in your bank account after you've paid for everything. Lenders want to see that you aren't draining your entire life savings to get into the house. They typically want you to have a few months' worth of mortgage payments, principal, interest, taxes, and insurance left over. Why? Because if you lose your job the month after you close, reserves are the buffer that keeps you from immediately defaulting. It shows stability. It shows you're a planner. The underwriter will source every large deposit in your bank statements. That $5,000 that suddenly appeared 2 months ago? You'll need to prove where it came from. If it was a gift from a relative, you'll need a signed gift letter stating it's not a loan. They're making sure your capital is legitimate, stable, and sufficient to weather a storm. The third C is collateral. This is the house itself. You can have a perfect 800 credit score and $1 million in the bank, but if the house isn't worth what you're paying for it, the deal is dead. The bank is not just lending money to you. They're lending money against the house. If you stop paying, their only recourse is to take the house and sell it to get their money back. This is where the appraisal comes in. An independent, licensed appraiser will evaluate the property, comparing it to similar, recently sold homes in the area to determine its fair market value. This is one of the most nerve-wracking moments of the entire process. If you agreed to pay $400,000 for a home, but it only appraises for $390,000, you have an appraisal gap. The bank will only lend you money based on the appraised value, the $390,000. That $10,000 difference? You either have to come up with it in cash, the seller has to lower the price, or you have to meet somewhere in the middle. If you can't, the deal can fall apart. The underwriter sees the appraisal as the ultimate backstop. The collateral must be solid. Finally, the fourth and most famous C, credit. This is your financial report card. The underwriter will pull a comprehensive credit report, looking at your FICO scores from all 3 bureaus. But they go so much deeper than just that 3-digit number. They are reading the story of how you handle debt. Do you pay your bills on time every time? A single 30-day late payment in the last year can be a major red flag. How much of your available credit are you using? This is your credit utilization ratio. If you have a credit card with a $10,000 limit and a $9,000 balance, you look like you're stretched to the limit. They're also looking at the length of your credit history and the mix of credit you have, things like car loans, credit cards, and personal loans. They're looking for a long, consistent, and responsible history of managing debt. Any collections, judgments, or bankruptcies will be scrutinized. You'll likely have to write letters of explanation for any past credit mishaps. Your credit history is your promise to the bank, written in data. It has to be a promise they can believe in. Once the underwriter has analyzed all 4 C's, one of 2 things usually happens. You either get a conditional approval or a denial. A denial is heartbreaking, but it will come with a specific reason you can work on. But a conditional approval, this is a huge milestone. It means the underwriter is saying, I'm ready to approve this loan if you can provide me with a few last things. These conditions are often simple requests for updated documents. Your most recent pay stub, a new bank statement, or an explanation for that weird transaction we talked about. This is the final sprint. You and your loan officer will work quickly to gather and submit these items. The underwriter reviews them, and if everything is satisfactory, they issue the 3 most beautiful words in the home buying process: clear to close. That's it. The final green light. It means the underwriter's work is done, the bank is ready to wire the money, and you are heading to the closing table. That's where you'll sign a mountain of documents, a process that feels both momentous and slightly surreal. You'll hand over your cashier's check for the closing costs, and in return, you'll be handed a set of keys. And in that moment, all of this, the complexity, the stress, the paperwork, it all crystallizes into a single profound feeling of accomplishment. You didn't just get a loan. You navigated one of the most complex financial systems in the world. You proved your capacity, your capital, your creditworthiness. You chose the right mortgage product from a sea of options, you won the negotiation for the right house, and you conquered the underwriting process. That key in your hand isn't just a piece of metal. It's a testament to your hard work and your financial discipline. It's the key to a place that's yours. From understanding the fundamental difference between a fixed rate and an ARM, to seeing how an FHA loan can open doors, or how a VA loan can honor your service. Our goal throughout this journey was to demystify the process, to transform the mortgage from a source of fear and confusion into a tool you can use with confidence. A mortgage is the leverage that turns your savings into a home. It's the financial engine that builds long-term wealth for millions of American families. And now, you understand how that engine works. You are no longer just a borrower. You are an informed, empowered buyer, ready to make one of the most important financial decisions of your life. The path to homeownership is a marathon, not a sprint, but you are now equipped with a map. The next step is yours to take.